Give us your take about where valuations are across Asia, given that we are seeing this rally. But at the same time, going into this pandemic with the U.S. rally, we have talked about how Asia might look cheap.
Thank you for having me. We are obviously in uncharted waters with lockdown directives being lifted in certain places in the globe, continuing in others, and being reinstated. With these reopenings happening, I would like to emphasize that I do believe that we are only in the very early stages of discovery of how the global economy is going to function in a post-COVID world. I do think that second quarter earnings are going to be bad. We could perhaps have some bright spots. Domestically oriented companies, those producing goods and services for domestic consumption, gaming, e-commerce, software, are obviously better positioned than export-oriented and commodity companies, especially those in energy and other extractive industries where the results are going to be poor. So I'm very cautious on my medium and even long-term outlook for the markets. I perceive there to be a very large disconnect between stock market valuations across the globe and underlying company fundamentals. I think headlines such as green shoots are emerging as lockdowns ease. I think those are misleading and very incongruous with the revenue and profit realities for the markets that I look at.
You have around a 25% allocation when it comes to South Korea geographically. Why do you like the market there? And are there any concerns over potential pressure now coming with how much they have to support the economy and what that could mean for debt and perhaps the risks for the financial sector in South Korea?
Sure. We do like Korea. We like the raw value there. We like some of the corporate governance improvements that you've seen there. I think it's important to highlight that for anybody who missed it, the head of one of the main chaebols there, J.Y. Lee, recently announced that he would be the last of his family members to lead the South Korean conglomerate. He will instead rely on professional management teams and increasingly independent board members. An announcement like this was just unimaginable just a few short years ago. So we do have a big allocation to Korea across different sectors: electronics, batteries, auto components, internet, snack food, and then even advertising. So we do have a weighting in Korea. But in terms of, the risks and where I'm seeing them, I'm definitely worried about debt in the emerging markets. In particular, one area of debt that has me quite worried is the Chinese residential property sector. The explosion of debt you've seen on the balance sheets of the listed residential property sectors is concerning, as is the cross-currency risk that some of these players have taken on. They're issuing U.S. dollar debt when all of their business is entirely RMB denominated. And then that's not even to mention the dependency of both local governments and the local governments in China and the national government on the proceeds from land bank sales. So I think, simply put, the residential property sector presents a challenge to the Chinese authorities dependent on revenue from land bank sales. On the flip side, I think that something that I do find comfort with is the increasing depth and breadth of emerging market local currency bond markets. Almost all emerging market countries learned a very hard lesson in the 97 financial crisis. Most of these markets today are self-funding primarily in their own local currencies. So while countries like Brazil are in unenviable economic straits with their budget deficits and pension liabilities, the recent move in the Brazilian real doesn't mean a dramatic increase in local currency value of their sovereign or corporate debt. They just don't have very much of it. So I think the emerging markets as a group have worked very hard to broaden and deepen their capital markets over the past 20 years. Many have made great progress. I think Indonesia, India, Mexico, and certainly China, and I would put Korea in there, deserve mention as having deepened and broadened their capital markets.
Kate, as you rightfully point out in your notes, COVID has severely dislocated the idea of globalization and global supply chains, right? So if you're bullish on Asia, how do you, hedge those risks? How do you take a localized play when it comes to Asian markets when so many of the ones that you favor, the likes of South Korea, other fast, recovering economies like Taiwan, are very export and supply chain exposed?
Sure. So as you stated quite clearly, COVID has derailed globalization, and we're very conscious of that. We are invested for the long term, and we do deep dive research into companies before putting them in the portfolio with the intention to hold them for long periods of time. We continue to focus on companies that generate most of their revenues and cash flows from goods and services that are produced and consumed domestically or regionally, rather than companies that are dependent on trade and export primarily with the U.S. and or Europe. So, we're seeing opportunities in the media sector, cloud, food and beverages, healthcare services, insurance and pharmaceutical sectors. We're not seeing so many opportunities in materials, energy, or telecom. If it would be helpful, I could mention one name that we have, a stock that we have in our portfolio, to give you an idea of the kinds of opportunities that we see investing in the emerging markets.
Sure, Kate, go for it.
Yeah, sorry about the delay here. So one of our portfolio holdings that I will mention, just an example of the type of companies in which we invest, is a Chinese media company. It's called Xinhua Windshare. Its ticker is 811HK. So this is a publishing and media company located in the Sichuan province in Western China. It's a retail bookstore. They print textbooks, and they're increasingly moving their offerings online. So we like it because it has a large amount of cash and securities on their balance sheet, top-line growth, stable margins, a very nice yield, 6% dividend yield. We think that will continue as they just paid their dividend this week, and it has a very compelling valuation with the H share that we own trading at a pretty significant discount to its A share counterparty. So hopefully that gives you an idea of our portfolio strategy and trying to stay invested in companies that are not as dependent on global trade.